Good day, traders. This is the daily market update live from the Tradelo trading floor. It's Thursday, the 18th of April. Some highlights from today's show. Is it time to buy the dip in the risk markets? Higher yields are as good as rate hikes, and the UK pound is about to get pounded. Let's start off with some of the key observations from yesterday's trading session. Oil was down $3, as well as the VIX got hit quite hard all the way from 19.7 at the start of the week to close down at 18 yesterday. So really seeing a squashing of that VIX. We also noticed the volumes were very much a lot lower than what we'd seen at the start of the week. Now, this is quite normal going into the end of last week. We obviously had geopolitical concerns with what was going on in Iran and Israel, and as a result, the market went into last week very much hedged against some form of an attack over the weekend. Now, we got that attack. The result, however, was that it was sort of a one and done. Iran said, we've now call it square ultimately. And we came in on Monday, and yes, there was still a little bit of volatility within the markets, but by and large, the market accepted that this is now a done deal. Now, yes, we are still seeing Israel saying, we've got plans to attack, and we were thinking of attacking on Monday, but now we're waiting, and the newsroom is sending out all sorts of signals. But in reality, the market's now washed out that geopolitical pricing. And we can see that with the move in oil yesterday. Like I said, we were down 3% in oil yesterday. Now, looking at today in terms of news flow, there's very little in the way of news flow. We have the initial jobless claims coming out from the US, which we do pay attention to. In particular, it's something that when or if we get a recession at some point, we will see it there predominantly. It's a very good leading indicator. But by and large, we are light on news flow. Now, that matters because there were two key risk events for this week. One was there going to be a retaliation from Israel? It seems as though the answer to that is no. And the second key risk event was, does Powell turn hawkish on inflation? And the answer to that was also no. Yes, he confirmed that the recent data is a little bit concerning, but he did not turn hawkish on the inflation. Now, with those two key risk events out of the way, what it means is that the VIX probably is going to continue descending its way down towards last week's lows, which is around that 15.5 level. So why that matters? Well, that brings us to one of the key plays for today. Is it time to buy the dip in the US equities? Well, the short answer is, well, when you have a VIX that's compressing and coming down, when you have geopolitical concerns that are out of the way, and when you have now got an environment in which the risks for the week are all gone, it is a constructive environment to look to start to buy the dip in equities. Now, looking at the chart, what you can see is that yesterday in the US session, in particular the S&P 500, we had some really key levels around that 50, sort of 60 area. We did have a little bit of activity below there. We got quite a few people interested in the shorts below there. Volumes picked up as we broke out of that consolidation range that we've been stuck in on Monday and Tuesday. However, the result was it got bought up quite easily. Okay, there was quite a lot of absorption down there, quite a lot of interest to be long down there. The market did rebound. Yes, it closed weak on the day, quite a weak close. However, like I said, it's a constructive environment for buyers now. So don't be surprised to see those buyers step in. Equally, keep in mind, there are now fresh shorts in the market as a result of Monday and Tuesday session. So what we're looking at on our floor, we get above that 50.61 again today. It looks as though we should have an easy pathway up to 51.25 and then a retest of that 51.50. So a very constructive environment from a risk reward perspective for short-term tactical plays towards that 51.50 marker. Like I said, though, the key is going to be VIX. If that continues to compress like I expect it to do today, you should see a very constructive environment for risk to rally. Now, looking at some of the other key things to pay attention to, higher yields are as good as rate hikes. Again, I've provided you with a chart there. What do we mean by this? Well, look, you go back to last year when the Fed told us in the September meeting that, these higher yields, in essence, that we're seeing are effectively de facto tightening. In other words, they told us they don't feel they need to hike interest rates simply because their markets are already doing the tightening for them. And that's September last year. We can see that the 2-year yield was around that 5.2%. Now, what you'll notice from this chart with the 2-year in orange and the S&P in green is that when we get higher yield environment, that's not a very good constructive environment for risk. In other words, yes, risk can go up, but it struggles when we have got a high yield environment. That's important to note, because if these yields continue to rise, that's going to cause a great difficulty for the equities to continue this rally this year. In other words, we're unlikely to get record highs should that 2-year yield remain around this 5%. However, and this is key, if those yields do start to pare back, okay, and we do start to see them come off somewhat, that is again a very constructive environment for the equities to rally and start to make those record highs again. So all in all, pay attention to those yields. They are very much pointing in the direction of higher yields, as we obviously see the Fed turning a little bit more concerned about recent inflation and pushing back this idea that they're going to cut 3 times this year. Then finally, one final interesting chart for today. The pound is about to get pounded. A really interesting chart here. BOE's Bailey comes out yesterday and pretty much tells us, look, yes, hotter inflation, but mostly expected. And he said something really key yesterday. He told us that he thinks next month's inflation is going to be really, really low. A really big down move in the inflation next month. Very much preparing the ground for the BOE to begin the process of cutting rates at the same time as the European Central Bank. Now, why does that matter? Well, because what we know is that currently the ECB is very comfortable cutting in June. The BOE seems like they are also going to be very comfortable cutting in perhaps May when they get their updated forecasts. And as a result of that, we've got a significant divergence between the US Federal Reserve's policy rate and the UK and European central banks. Now, what that means is we should see interest rate differentials go in the opposite direction. Okay, and that's key as the spread widens between what rates are in the UK versus the US. That should put a very strong offer into the pound. Now, couple that with the technicals. We've broken that 125. It was very much a 6-month support range. The market seems to be responding quite well after that break. We've got some good volumes there and real lack of interest to be a dip buyer. What that means, though, is pound has got some serious pounding all the way down to 121 over the coming weeks and perhaps months. So keep an eye on that. That is a sell-only market. The pound is going to offer some really good opportunities to the downside. Now, let's wrap up for today. Like I said, in terms of macro or economic news, there's nothing really too much to pay attention to. No real risks today. Like I said, very constructive environment to perhaps look to buy that dip as we have got shorts in the risk markets. And then finally, remember, good luck today. Make sure you're managing that risk and go make some money.